My first guest today uses the words dangerous and violent to describe current markets. Investors would be hard-pressed to argue with that, given stock losses over the last couple of days. Mark Luschini is chief investment strategist at Janney Montgomery Scott, where he oversees $54 billion, and he joins us now from Pittsburgh. Mark, welcome back to Bottom Line. Always a pleasure to have you on.
Good afternoon, Mark.
Mark, nearly $3.5 trillion has been wiped from global equity values just this week. This isn't a flight to quality. It's just a flight, period. Today's modest rebound notwithstanding, though, are we seeing overseas contagion spreading to Wall Street? And are we in a bear market, perhaps not in the traditional sense, but in a psychological sense?
Well, certainly, if you look at levels of consumer confidence, or for that matter, even confidence readings in the National Federation of Independent Businesses, small business owners, and even larger corporation CEOs, it would suggest as much. I think there is some risk of spreading contagion, at least in terms of sentiment towards risk assets, and that's what's playing out in the equity markets. It's really tough to ascertain how much of what contributed to yesterday's decline in equities came solely from disappointment in what the Fed statement relayed, or how much of it is lingering concerns about Eurozone. And of course, for an additional benefit, we have the trifecta of China, of course, where they reported their third consecutive month of having their PMI reading come in below 50, which is indicative, of course, right on that line of demarcation between boom and bust. And that's disconcerting when you consider they're, by many accounts, considered to be the world's global growth engine.
Right. And Mark, you just hinted at it a moment ago. This week, the Fed announcing Operation Twist, that effort to drive down long-term interest rates and make it cheaper for people and businesses to borrow money. Wall Street wasn't impressed. Is the Fed out of options at this point?
Well, not necessarily. I mean, certainly they could change the amount that they're paying on reserves that banks are holding at the Fed from perhaps the current 25 basis points to maybe something closer to what 1 or even 2-year paper is yielding, which is probably more on a 10 basis point kind of level. And that might encourage the banks to lend some of that money out. I suppose there's other alternative measures as well that they might consider, including the launch of QE3. But you can tell by the fact that we've had now 2 consecutive meetings where there's been 3 dissents on the part of Fed policymakers from voting for any additional action, which suggests there's some political infighting inside the Fed that would make the hurdle rate for some additional policy measures to be quite high.
Mark, this turbulence that we've been seeing in the global markets this week, what's the chance that it's going to spill over into the real economy?
Well, I think the chance is, unfortunately, higher than I would like it to see. I've been suggesting that our base case is that we will avert a recession here, but we assign about a 1 in 3 chance we could, in fact, encounter one. And I would contribute the fact that it could occur, given, one, the low margin of safety that we have with a growth rate of 1.5% to 2%, certainly accounting for an exogenous event from the Eurozone or a spike in oil prices or China. But we could, in fact, talk ourselves into a recession by more and more displays of partisanship among policymakers, or unfortunately more untoward events seeping onto our shores, driving stock prices both up and down violently, which I think helps to further erode confidence and could have consumers pulling in the reins even more than they already have.
Well, Mark, following talks today in Washington, a group of 20 officials said that they were, quote, committed to a strong and coordinated international response to address the renewed challenges facing the global economy. That sounds promising, but words are not solutions. What do investors need to hear from central bankers around the world that will give global markets some traction?
Well, I mean, we've been hearing a lot of that to date, and so far it's been the lack of action that's been disconcerting for investors, because every day that passes, the situation becomes more acute. Greece is coming closer to running out of money. The ECB continues to buy the sovereign debt of Italy and Spain, and that's helping to some degree, but at some point they're going to run out of the purchasing power, let alone some of the countries like Germany and Finland and probably even France are going to lose the intestinal fortitude to continue to possibly be putting good money after bad. So what they need to do is what perhaps has been hinted, which is to either, some type of Euro TARP program, supersize the European Financial Stability Facility, accelerate the introduction of the European Stabilization Fund, anything that would actually put into play enough buying power that would suggest to the marketplace that we've got this, even if it required other central bank contributing to that exercise, whether you're talking the Bank of Japan or the Federal Reserve Bank here in the United States.
Mark, we have about a minute left. You were talking about the Eurozone and Greece. The markets, they appear to be pricing in the likelihood of a Greek default, even with the help of billions, as you mentioned, from the European Union and the International Monetary Fund. Is Greece in too big of a hole to be helped at this point? And do taxpayers in those AAA-rated countries you mentioned, Germany and Finland, do they have the stomach to part with more cash to increase the size of a rescue fund?
Well, to answer the latter first, it doesn't seem to be the case that they do. But I don't know what choice they're going to have other than wanting to make sure that an exercise and kind of engendering the moral hazard of bailing out Greece helps to keep the euro intact. And there seems to be some widely held support for that, of course, led by Angela Merkel in Germany. But, the fact is, I think by most accounts, it is a foregone conclusion that a default is inevitable. It's a function of whether it's going to be disorderly or orderly. So it seems as much as anything, European officials are trying to buy time to allow for their banks to be able to either recapitalize or hopefully see some growth that might ultimately bail out the Greek situation before the countries have to reach in their pockets in order to be able to do so.
Mark Luschini, Chief Investment Strategist, Janney Montgomery Scott, joining us from Pittsburgh. Mark, have a good weekend. Thanks.
Thank you, Mark.